All right, everyone. Thank you so much for joining for this roundtable discussion about crypto trading. I'm Miguel. I'm the CEO of Arkham Intelligence, which is a data analytics company focused on cryptocurrency trading and sort of working with hedge funds to provide them with information about the people who are actually moving around crypto markets. So today, the conversation we're going to be having is about unpacking the fundamentals of trading in crypto markets. So where we can start is by sort of discussing the actual paradigms of crypto trading and trading more broadly, and how it is that people actually make investment decisions and actually make trading decisions within the space. So we can start with sort of the first and most traditional and most popular form of trading, both cryptocurrency but also traditional equities and other markets, which is asset fundamentals. And so when analyzing asset fundamentals, this is also kind of what people would describe as sort of Warren Buffett style, more traditional investing. So looking at the information about the company or the asset that you're investing in, this would include things like balance sheet data. So, how much do they spend? How much money do they make? Are they profitable? What do sort of their future prospects look like in terms of revenues and so forth? Looking at the executive team, so the people who are actually making decisions for that particular asset class, that can obviously have a huge, sort of effect on the price of a particular asset. One of the sort of like core examples of this would be like Elon Musk, right? So companies like Tesla, they end up sort of trading at a much higher premium than other kinds of similar companies in their industry because the leadership team is considered to be top tier. Just because Elon Musk is involved in a project, it sort of commands a much higher valuation, higher price. Central bank policy, this would be sort of thinking about the overall macro environment. So how much does interest rates play into this particular company, right? Do they have some kind of supply chain problems that occur now as a result of rate hikes? Is this the kind of thing where because the central bank is making significant changes, does that then change the market for this particular kind of company? Additionally, other sorts of things like sector trends, understanding the valuations behind the market that you're actually investing in, right? Companies that trade, for example, within the crypto space or other kinds of fintech companies, as an example, will trade at a much higher premium than other sorts of, sort of older, more established industries. It's much more likely that a crypto or other kind of fintech startup will trade at a much higher multiple than, say, for example, hotel chains. Lastly, people also try to think about, stock to flow. So what is sort of like the overall issuance of the security? How many new shares are being minted? How many new tokens are being minted? And how does this sort of correspond to the overall number of buyers in the market and the overall money coming into the market? And then the last thing would be what could be described as, activist investing, right? So who are the external parties? So not necessarily the internal team, but who are the external parties that are actually trying to influence this particular company in order to, make it better, right? So this would be like an example of, Bill Ackman would be known as sort of like a activist style investor, or, Paul Singer, where when people actually get into these companies, they come in and they kind of whip it into shape, and then the stock price ends up going up as a result of them coming in and actually influencing the company itself. The second paradigm of trading would then be price data. And this is a much sort of newer form of investing compared to asset fundamentals. So this could be described as, technical analysis is generally how people talk about it. So this is sort of people staring at screens, looking at, green and red bar charts, and using this to try to understand more about, based on what these particular, bars are doing on this chart, can I make some sort of prediction regarding where the price is likely to head in the future? And so what this looks like is people sort of describing the patterns that you see on the board as sort of typical kind of like support. So this is one sort of common thing that is discussed within technical analysis. So that would be thinking about sort of what are the support levels, the key support levels for this particular asset, what are the key sort of resistance levels, and they sort of think about these as sort of bands. And then you can sort of think about it kind of like a ping pong ball going between support and resistance is typically the way technical analysts and traders tend to describe this, right? So, some of the common patterns that people talk about, they'll talk about bull flags, bear flags, things where, based on a particular sort of pattern of the candlesticks, you can then say, okay, well, every single time that for this particular asset, this chart has appeared, it has then made, X action. So every single time it paints this particular picture, it then, goes up or it then goes down. So that's typically how people tend to think about it. Additionally, there are other sorts of things such as regression. So if you ever hear about people speaking about an asset sort of reverting back to its mean or reverting back to its moving average, this is another sort of style of technical analysis where if an asset sort of broadly has some moving average or some sort of typical price range that it trades between. So you could say, well, over 95% of the history of this asset class, it has traded within this band. It has always traded between $1 and $2. If it ever falls below $1, theoretically you could say, okay, well, I'm going to long because historically speaking, unless something major has changed with this particular asset or with this company, it should kind of revert back to its sort of typical moving average or its typical band. Same thing if it's going above, right? You could sort of short that asset and then try to make money off of that. Additionally, you can sort of make the trading strategies even more complicated. People then, for example, can do things that are referred to as pair trades. So for example, if you have two assets that are both in the same sector, very similar kinds of companies, and you see that they sort of trade within the same sort of like range or the same band, given that they're incredibly similar, if one of them sort of escapes to the upside of its band, and then company B, which is also very similar to company A, then begins trading below its band, then theoretically you could long company B, short company A, and then both of them should revert back to the mean and start trading within a band with each other again, hypothetically, and then that would be sort of a way of you being able to make money on both sides of the trade. Now, the third dimension that exists of investing is transaction data. So this is what we at Arkham refer to as transaction level analysis. And so when you're actually doing transaction level analysis, you're not necessarily looking at the fundamentals of the company. You're not looking at just necessarily price data, but you're actually looking at this third aspect, which is focused on who are the actual players that are moving the market for this asset class. So who are the people who are purchasing this particular asset? Who are the people who are selling this asset? In what quantities? Can you study their portfolio? Can you come to understand how their market, how their sort of purchases and sales then sort of moved the market? Now, the interesting thing about transaction data is that it does exist within sort of more traditional markets such as equities, for example, but the data is actually guarded by brokers, exchanges, regulators, these sorts of players. It's not necessarily publicly available unless it's into a kind of particular size, right? So the SEC has regulations around, what sort of disclosures actually need to happen at what times. So for example, if you have a public company, if somebody acquires more than say $100 million of that particular asset, then they're required to file a form with the SEC, which then gets publicly disclosed so that retail investors can understand, okay, now this is a major player for this particular equity. Same thing if somebody acquires 5 to 10%, if not more, of a stock. Again, they're required to file, I think within 90 days, in order to let the public markets know that this person is now taking a position. And typically, those sorts of purchases or sales will then lead to large market movements. So for example, when news came out that Elon Musk was going to buy Twitter, right? Like that's the kind of thing that can dramatically move the market. Same thing, when he started pulling out of the deal. That's another thing that moved the market. And then he came back in and then it sort of moved the market again, right? So all of those kinds of sort of volatility based on new information is how you make money in the market. Without volatility, without new information coming in, there's no edge, there's no movement. You can't make money off of a stale asset. Now, the interesting thing is that crypto is a bit different because all of this information actually exists publicly because a lot of the trades happen on chain And if they don't happen on chain, say they happen to an exchange, there's still signatures of what these players are doing, whether or not they're buying or selling, and what assets it is that they're actually moving. Now, the difficult thing is that the actual information within the cryptocurrency space is difficult to use and is difficult to kind of actually derive insights from it without having more sophisticated technology, right? So you can't just sort of look at the Bitcoin blockchain or look at the Ethereum blockchain directly and say, okay, well, I'm looking at this and now all of a sudden, I'm a genius when it comes to the market. You actually need to know who the players are behind those transactions. You need to know who owns those blockchain addresses and sort of try to get a much clearer and larger picture of what it is they're doing when they're actually making the movements on chain. So trying to understand who these different market players are, who these people who can influence the crypto market are, is very important. So I'm going to describe to you a little bit of sort of the overall market structure and the different kinds of players who are involved in actually, being able to move the price of a particular asset so that then you can study them, take advantage of their movements, and then be able to make money over time. So with the crypto market in particular, you have the token projects themselves, right? So each one of these tokens, each one of these assets, generally there will be some sort of project behind it, some sort of group that you can study to try to understand more about what it is that they're actually doing, with some sort of key exceptions like Bitcoin. Obviously you can't sort of study Satoshi Nakamoto. He hasn't really moved his coins at all, so no insight there. But for example, with other sorts of smaller and other Web3 projects, there's plenty of information about the token projects and what it is that they're doing with their money. In particular, the treasury of the company, right? So typically the largest holder of any given token will often be the project itself, right? So if you have a company and they're issuing a ton of tokens on exchanges that you can purchase, the most meaningful movement that can happen is if the largest holder, that being the company, then begins to sell significant numbers of tokens or begins to purchase significant numbers of tokens. Both of those things can be incredibly meaningful. The second largest player would then be the token project insiders. So that would mean, for example, the CEO of the company. So typically the CEO, the COO, the CTO, the original sort of founders, they will tend to own sort of exponentially more tokens than any other individual within the company or even sort of like externally. And so monitoring for the CEO, COO, et cetera, of these projects can be a really great way of sort of extracting alpha, where if other people don't know that these insiders are selling, they could be selling for a variety of different reasons, right? It could be that they legitimately need the money. It could be part of a selling schedule. Or it could be that they're bearish on their own company. In that case, it's even more important that that they're selling because they have the most information out of anybody in the market about what's actually going on behind the scenes. So this is sort of another very important player that you can actually study. The third is the market maker or liquidity provider. So generally speaking, these token projects, when they list on exchanges, large exchanges, they will be mandated to have a market maker or liquidity provider. So these are essentially trading firms that they're called market makers because generally speaking, they're taking market neutral positions, just providing liquidity on either side of the books. So they're both buying and selling assets within the order book, within the marketplace. And the reason why market makers are important is because they will typically be controlling large amounts of the supply and also large amounts of the cash that is influencing the market. So generally speaking, the market maker's job with respect to the token project and the exchange is to try to reduce the volatility within the market. And what that means is when the price of a particular asset is going down substantially, they are kind of a backstop of liquidity that will then step into the market and then try to prevent it from crashing further. So they will have, let's call it this big pot of money, right? They sort of act in this way, sort of similar to central banks and governments. So they have this big pot of money and then they have this big pot of tokens. And basically their mandate is when the price goes down, you step in with your big pot of money and you start purchasing tokens off of the public market in order to get the volatility to reduce and sort of calm the market down, because you can get cascading liquidation effects where as more people are selling, people begin to panic. It causes further selling. People begin to panic even more selling, so on and so forth. So generally the market maker will step in and try to, cause there to be some purchases that happen, and then therefore, that kind of reduces the overall number of sales as people realize, okay, now this is sort of not starting to crash as much. They're setting, obviously, what I could describe previously in the technical analysis sense, price floor, right? They're setting a support for the overall asset class. Additionally, if the token is sort of rising, like a huge exponential amount, then they can actually sell tokens into the market. So this is the kind of thing that can, for example, raise money for the project, right? So the project holds a bunch of tokens. Their goal is to increase the amount of revenues and money in the bank for their particular company. Therefore, they can use those tokens, sell them into the market through their market maker, raise money for the project, then use it to, for example, pay engineers or pay for marketing expenses, so on and so forth. So they leave that to the market maker because as a company, you don't want to sort of be trading 24/7, trading your own token, constantly focused on the market. You need to be building your product. And so understanding who are the market makers behind the projects and what are their mandates? What are sort of the support levels that they're targeting? What are sort of the resistance bands that they're creating in order to begin saying, okay, well, once the token reaches this price, we're going to start selling in order to raise more money for the treasury. Those are the kinds of things where if you understand it, then you know, okay, well, when the price hits this particular level, I'm going to go long because I know the market maker is going to step in and the price is going to increase and then I can sell. Or if the price is, going up higher, you could say, okay, well, this seems likely where the market maker is going to, kind of step in, begin selling tokens for the project. I can go short and sort of take advantage of the price movement to the downside. Fourth, you have retail investors and traders. This group matters more or less depending on what particular asset you're trading. It's kind of funny because the retail investors and traders tend to matter more on sort of like the two sides of the token spectrum. So they matter a lot for kind of very small projects, and they also matter a lot for kind of very large projects. So for example, retail sentiment, very, very important for Bitcoin, right? At the same time, it can also be very, very important for a very small project. It's somewhere in the middle where, the institutions, the partnerships, the insiders start to matter more than kind of, the retail investors. But overall, for very large companies and then for very small companies, retail investors matter. Now, one example of where you can sort of study the retail investor and retail investor flows would be in something like a Dogecoin or in, Shiba Inu. Right? Like these are tokens where the retail flows and the retail traders are basically driving all of the demand for these projects, right? Companies like Robinhood will list something like a SHIB, and then the retail investors will all sort of pile in, and that's why you get a ton of volatility on projects like SHIB, where it can rise a ton, it can fall a ton, and it's not really a stable market at all because there's no professionals involved. It's all kind of retail investors. So understanding the retail flow will then give you a better sense for where the price is likely to head in the future. So I'll sort of do a quick run through of the bottom ones. Institutional investors and traders. This is where you can sort of analyze, okay, who are the large hedge funds involved in this particular project? Large hedge funds and institutions have a large amount of capital. When they come in, they don't come in for $10. They come in for 10 million. And if you have an asset class, depending, if you have an asset class with not billions of dollars of liquidity sort of lying around, somebody stepping in with a $10-20 million public market investment, that can matter a lot. It's the kind of thing that can move markets. VCs, so venture capitalists coming in, they will also be sort of in the same broad category of token project insiders. There are people who don't necessarily work for the company. They're external, but they have large stakes. They'll typically own somewhere between 1% and 10% of the company, so their holdings do matter. And understanding all of the dynamics of the VCs, especially as you add them all up, right? So if you have a few venture capitalists, let's say you have 10 of them, each of them owns, let's say 2% of the company on average, 2-3%. Now all of a sudden you're accounting for 20 to 30% of the overall sort of project treasury. If those people all start dumping at one time, your supply is going to increase dramatically, right? So that's the kind of thing that can really decrease the price of your token. governments and regulators. Obviously, if the SEC is going to step in and make an enforcement action on your company, that's not a good thing. You don't want to be in a long position when the SEC sort of sues your project. And then the last thing to monitor is the media. So media also has a really large kind of effect on the sentiment of a bunch of the players who are involved, right? So media can influence institutional investors, media can influence government, media can influence VCs, retail, all to kind of, dump this token or, buy more of it by virtue of them saying this project is good or bad. So monitoring the news is also very important.